I'm here again with Casey Allen, the founder of the Enterprise Rising Conference. Casey, what is your favorite piece of feedback that you've heard over the years about Enterprise Rising?
One thing founders give me a ton of feedback on every single year, now that we've done this 5 years, is the talk in which I bring a founder up on stage whose startup crashed and burned, and they deconstruct why they think it crashed and burned, what went wrong, and what they might have done differently. And these are often very high-profile founders who had everything going for themselves, but they still couldn't quite turn the corner. And so those are the kind of talks that, quite honestly, founders give me a ton of feedback on. They loved it. They want to hear more about that because it's really educational.
How is Enterprise Rising different this year?
If you've ever attended an online event, you know networking sucks. Slack and Discord really just don't cut it. So we have custom built for Enterprise Rising 2020, an online platform that's like Startup Masterclass meets The Sims, where every attendee has an avatar, you're in a building, you're sitting in chairs, you're sitting in couches, you're having real video chats with the people next to you. So what we've done is we've recreated an actual virtual environment where networking happens just like it does in real life.
Casey, when is Enterprise Rising and how can people get involved?
Enterprise Rising is the end of October, the 20th and 21st. It's 2 full days. It's all online, so you can dip in and out for as much or as little as you want. Go to enterpriserising.co. That's enterpriserising.co. And you can use discount code UPSIDE to score 20% off as many tickets as you want. So discount code UPSIDE at enterpriserising.co. All the details are there. The entire conference is online. It's going to be a great time.
I don't know that I was really specific before the call, but during the call, I was like, hey, look, here's the deal. You're in the middle of raising your second fund. We're doing the same thing. We seem to be on exactly the same track.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside.
Woo!
Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Jay Klaus, and I'm accompanied by my co-host, Mr. Smoke 'em if you got him himself, Eric Hornung.
If you'll notice, my voice is a little bit Bob Dylan-y today, Jay.
Why is that, Eric?
There's a little rasp. There's a little grit on this voice, a little grit on these vocal cords. Well, last night I had a couple of adult beverages, you might say.
As is your right.
Right, because I'm an adult and I can have adult beverages. I had a couple glasses of vino, and we polished those off. And maybe we didn't polish them off. Maybe we did it simultaneously with a nice. You ever smoke cigars, Jay? You ever heard of a cigar?
Yes, I've heard of a cigar. Almost never have smoked a cigar.
Since I got into golfing, I've also gotten into cigars. So there's been like a 1-to-1 correlation there.
I've never experienced like a good cigar. I feel like you smoke your first cigar in high school and it's like not even a real cigar. And then you're like, you know what? Maybe that's not for me. But what's really not for you is just like Black and Milds.
Apple Black and Milds. We had a thing in high school when we graduated called Senior Smoke Day, where every senior brought a cigar to school. Do you guys have that, or is that just
I think so. I think we definitely did like the aviators graduation gown cigar thing that most graduating seniors do.
Okay. I didn't know if that was just a thing we did or not, but yeah. So last night, if you guys are feeling a little rasp on this voice, a little bit of folky on the road grit, that's why.
Well, Eric, where there's smoke, there's Firebrand Ventures. And today we are speaking with John Fein and Chris Marks, the managing partners of Firebrand Ventures. And if you'll remember, we spoke with Firebrand Ventures and John Fein specifically back in September of 2018 as our second ever coffee chat on this show.
One of those people early on who took a risk on us when we were just a little fledgling, budding podcast, Jay. And it's awesome that we're having some of these people back on the podcast.
Great to bring John back, and specifically we're bringing him back to talk about something that we've never heard of before, because as I mentioned, we're talking with John and Chris Marks, the managing partners of Firebrand Ventures. And this happened in a unique way. But before we touch on that, let me introduce the two of them. Prior to founding Firebrand Ventures, John served as a managing director for Techstars, which is a leading startup accelerator with more than 40 programs around the world. And while at Techstars, he ran 3 accelerator programs in Kansas City, investing in 30 startups. Chris, on the other hand, was the founder and managing partner of Blue Note Ventures, an early stage venture fund investing in great technology companies and entrepreneurs committed to authentic leadership. Now, here's where this gets interesting, Eric. Something we've never heard before. After co-investing for a few years in several companies together out of their respective funds, Chris and John realized that they not only shared a similar investment strategy, but also an underlying set of values around how they partnered with entrepreneurs. So in late 2019, they joined forces and merged Firebrand and Blue Note.
They did. They pushed them together. So when I heard about this, I immediately sent John a note on the Twitter DMs and said, congratulations. Obviously, I think this would be a really interesting topic to talk about on the podcast. So diving into this interview, for the listeners, it is very, very, very uncommon that 2 financial services firms, specifically venture capital firms, merge. And I'm excited to see what that looks like.
Yeah, I've never heard of it before. I'm excited to ask them a lot of questions about it and how it worked, because it seems like there's a lot of stakeholders that are actually involved in something like this. So you'd have to get on board and do this. But you know what? It seems like John and Chris realized we only have one life to live. We might as well live that the best way that we can.
Just like our friends at Ethos Wealth Management. And if you want to learn more about Ethos Wealth Management, you can go to upside.fm/ethos.
We'll jump in here and talk with John and Chris right after this.
Let's bring in Meredith Sugar, a partner at Taft, Stettinius, and Hollister, to teach us about preparing for an exit. Taft is a full-service law firm known for assisting entrepreneurs across the heartland. As a reminder, the following remarks by Taft attorneys are for informational purposes only and are not legal advice. This information is not intended to create, and receipt of it does not constitute an attorney-client relationship. No person or organization should act upon this information without first seeking professional counsel. Meredith, thanks for coming in today. How's your day?
Good.
Meredith, I wanted to give you a hypothetical situation here. Let's say I'm a founder and there's an acquisition offer on the table. It's starting to feel very real that there'll soon be a lot of money in my bank account. So how might I, as a founder, think about estate planning services?
Well, although an acquisition certainly encourages business owners to execute estate plans, the time to have engaged in planning is yesterday, if not now, whether or not an acquisition is imminent. Avoiding the time and cost of probate is generally very easy to do by having a trust, especially for business owners. The trust will hold all that person's assets, including their business. Many other good reasons exist to have a trust. For one, a trust can keep children from inheriting at the age of 18, holding their funds in trust, even though the funds are always there for their support until ages later than 18. Tax planning is another good reason to have a trust. We currently have a very high federal estate tax exemption of over $11 million per person, but this exemption likely won't stay this high, and in the past few years it's been as low as $1 million. Passing away with more than this amount subjects a person to a 40% tax. Trusts are able to make the tax scenario as favorable as possible, and more creative types of trusts can help with wealth transfer to lessen the tax burden even more.
Something that no one thinks about, but everyone should be thinking about: taxes. Appreciate you coming on. And if people want to learn more about Taft or yourself, where should they go?
Our law firm website is taftlaw.com, and I can be found on the site.
John, great to have you back. Chris, great to have you here.
Great to be back.
Yeah, good to be here. Thanks.
We have had the John Fein experience on the podcast before, but Chris, you're new to the podcast. We'd love to start with you and Blue Note. Can you tell us about a history of Chris?
Sure. Happy to do that. So I'm in Boulder, Colorado, and I've been doing early stage venture investing here for going on almost 20 years now. You know, it was about 5 years ago that I got a little bit disillusioned with what I was doing in venture and decided to set out and start my own fund. That became Blue Note Ventures. Blue Note Ventures was a seed stage capital fund that focused heavily on the type of entrepreneur we backed. We were looking for what we deemed authentic leaders, which were people who were trying to create cultures of real transparency, and we were trying to model that in our own behavior as we interacted with these companies. So that was Blue Note Ventures. We invested in 13 portfolio companies, all early stage, We were kind of tech generalists looking to invest in the Rocky Mountain region, but also just anywhere between the coasts, and still managed that portfolio, and was just, it was kind of starting that fund is really when I crossed paths with John and when we got to know each other.
Usually when I get disenchanted with something, I don't go and then do that thing again. What were you like disenchanted with in the venture space, but not disenchanted enough that you went and started your own?
Yeah, that's a good question. It was kind of a series of events that, I've been doing it for a while and had invested. Venture capital has a bit of a reputation for being having some not so great elements to it in terms of, I guess competition for deals, competition among venture capitalists. And I just had a couple bad experiences, just in terms of investing in people that, let me put it this way, it was a bit of a pattern. We'd find a company, we'd get to know them, we'd invest in them, everything would be great, the world would be great, they'd be crushing it, and then one day the bottom would fall out, and I'd get the call of, oh my gosh, we have 30 days until we hit a wall, or oh my gosh, this has been going on internally, we haven't talked about it, and what I came to realize, it was really the dynamic between investor and entrepreneur that is kind of inevitable in the venture world. So I just took a step back and said, is this something I want to do, or could I do it differently? And that was the impetus behind Blue Note Ventures, was just an attempt to kind of do it differently, both in the type of people I invested in and the way I communicated with them. And I kind of figured the best way to do it was on the very front of any relationship to say, hey, this is going to be a little different. I'm going to be really authentic with you and really open with you. And that's the way this relationship needs to be for it to work. And, some entrepreneurs were excited about that. Some found it refreshing, and some kind of ran the other way. So we self-selected in terms of who we invested in. We self-selected in terms of the LPs that kind of backed that strategy. And we self-selected in terms of the, other funds that we co-invested with. And so it was a bit of an experiment, not only from an investment strategy, but also just, hey, how to make life better as a venture capitalist. I think it's worked on both fronts.
So it sounds like what you're describing, Chris, is that in a lot of the venture space, you were experiencing founders who didn't feel comfortable expressing the challenges they were facing or the things that weren't going so well to their capital partners in real time. It was waiting until it was really an issue that they couldn't ignore anymore.
Absolutely. I mean, I think the traditional venture relationship is one that says, as an entrepreneur, and many of these people are first-time CEOs or first-time founders, and they're thinking, well, geez, if these people have enough confidence in me to give me their money, then I should probably have all the answers to all the questions. And it right out of the gate, it creates this bad dynamic in terms of a relationship where you're maybe not getting the truth. And if you don't know the problems as an investor, you can't help, obviously. So yeah, that's absolutely the kind of fundamental disconnect we were trying to solve for.
You also mentioned that when you started socializing that to founders, some of them ran the other direction. Why do you think some founders would not want that?
Well, the truth can always be a little bit scary, right? And different people are looking for different things in their investors. I think some people would rather just take the capital and say, we'll check in with you on a quarterly basis and let you know how it's going. And others are really looking for partners in the trenches who are willing to roll up their sleeves and help and get into the nitty gritty and kind of help them solve the day-to-day problems. That's the partner we wanted to be, and we were very open about it. So if it wasn't a good fit up front, then we really appreciated companies opting out, and maybe run the other way is a bit of a strong statement, but it's all about finding the right match in venture, between investor and entrepreneur. So we were just trying to be a little bit more open and selective on that front.
John, obviously we know a little bit about this story of the two of you coming together. We'll get into it here in a second, but I know a big part of that was because you guys shared similar values. So what were you seeing, John, or what kind of brought you to the same realization that you wanted to operate Firebrand in the same way?
So, a lot of what I learned as a professional investor, or I guess that sort of started to serve as the foundation for my approach as a professional investor, were my experiences running the Techstars program in Kansas City over 3 years. And because one of the wonderful things about being a managing director for a Techstars program is the volume of founders that you get to interact with. So in any given year, you're probably interacting with, upwards of 1,000 startups just to get to the selection process for your program. And so those learnings that I had selecting founders for those programs and interacting with those founders and sort of trying to check myself and also leveraging my own mentors to sort of just figure out, are these founders the right fit? Or do they have the things that we're looking for? Going back to a couple of things that Chris said, like, are they authentic, right? Is there a high level of integrity? Do their values match, what we're going for with these programs? And so I think that's where it started for me, is when or at least that's when I really started thinking about it. And sort of my journey through Techstars and all the learnings that I had through those 3 years sort of formed the basis of that investment approach with Firebrand.
So, John, you were starting Firebrand about the same time in 2016. I'm actually going to turn this around to both of you, whoever wants to go first. When did you first meet one another?
It was in 2016, and I'm sure it was on one of my trips to Boulder. It may have been like a lunch at the St. Julian. Like, I forget exactly where it was. It was somewhere in downtown Boulder in 2016. And I do remember the reason we met was because I had reached out to the Techstars Boulder program, and I was like, hey, give me a list of your top Boulder VCs, like who are not just investors, but like who are the good people I need to meet in the investment community? Because even though I had a decent network there, it wasn't as a fund manager. And so I think that's where Chris's name sort of bubbled to the top. And I think that's when we first met.
Yeah, I think that's right. And I remember that lunch pretty clearly because we were both in the process of raising our respective first funds. I think I was a little further down the road, but you were just getting underway. And I was struck at that lunch. I'd certainly heard about John through the Techstars network, and I'd been a mentor in the Boulder program for a long time. But I just remember at that lunch. I mean, oftentimes when two VCs meet for the first time and they have lunch, it can be a little bit guarded. But I do recall at that lunch we both kind of commiserated over the process, had some good laughs over some of the people we were pitching and how it had gone. And so, yeah, I do remember leaving that lunch thinking, got to keep in touch with John. This is going to be helpful.
I like to fast forward a bit because you guys obviously did keep in touch and now you're merged two venture capital firms. But as you were going through that process of deciding we have a lot in common, we launched our funds around the same time. We both asked different questions. John, you might not know this, but we had Johan on from InKind, and he said the thing that really stuck out to him about you was your first question wasn't like about the fund. It was about how many hours of sleep he got at night. And you were hoping that he was exercising. I feel like you guys come at venture from a different way from that first question, that first conversation. But how did you think about, and it's easy to find similarities between people, how did you think about the differences between you and how those would work together in a potential partnership or merger?
The great part about, this process of sort of Chris and I coming together in the same fund is that we had 4 companies that we co-invested in together, Firebrand and Blue Note. And I think it was, through those co-investment experiences where, just naturally, because we already had a relationship or we had a building relationship, we would compare notes, we would talk every so often. There were 1 or 2 companies where we were like right on the same track, it seemed like, in terms of our decision-making process from a timing standpoint. And so I think that really helped, define in my own mind, like, hey, like first it was like, wow, we have a lot in common, like just as far as our outlook towards what we look for in founders, how we work with companies, and sort of the investment decision-making process. But also, I think what you said is the differences are really important as well. I should say, like, I would say our overall style is very similar, but we come from different backgrounds, right? Like Chris has more years of experience as an investor than I do, and he has it in a variety of different types of funds, and he has a legal background. So I don't have any of that. I was a founder, I was a startup person, an operator, and then I eventually made my way to Techstars and then Firebrand. And so I think those different types of backgrounds really help just bring different perspectives to the table. I don't think either one of us would want to have done this if, we felt like we were exactly the same and always brought the same things to the table, because that's really not, that's not too helpful in a team environment.
Yeah, and although we did 4 deals together in our respective first funds, we looked at several deals that one of us would do and the other wouldn't. So it was obvious from the start that we had some different views on investing. And I think from my perspective, as we were kicking around the idea of joining forces, one of the things that was attractive to me is that in this business, it's so easy. I mean, some people call it pattern recognition as a good thing, but it's also kind of falling into your own biases as an investor. And one of the things that was attractive to me was having, I guess, a different set of biases, a different set of experiences. It's just a healthy way to go. And I think it's broadened our investment horizon overall, by combining those.
The other thing I would add is that nothing ever goes perfectly. And, we all have our failures and our lessons that we've learned along the way. And naturally, we're going to have different types of lessons. And I think that's much more important than whatever successes that we've had in our past. And so I think just having different types of struggles and failures and lessons learned from those things are hugely important.
How important was the overall timing of this? And it seemed like both of you are going into a second fund. Was timing a big factor here for other venture firms that may want to merge in the future? Like, is there good timing or bad timing?
Well, yeah, ours worked out on a lot of levels. First and foremost, the fact that we got it done before the pandemic hit is something we're thankful for overall. But in terms of where we were as 2 firms, I think it was really helpful. I don't know if it's impossible to merge if you're at different stages, but we just happened to be at a point where we had both gone through an initial close, largely with our existing LPs from our first fund. We had closed but not called any capital. So it's a very unique position. We had gotten commitments, people had signed the paperwork, but we hadn't called any capital, we hadn't made any investments. And as a result, we were kind of starting with a clean balance sheet. So it was fortunate. I think it definitely sped the process up. I mean, we started talking about it around Thanksgiving of last year. And, despite the holidays and everything else, we closed right at the end of January. So it was a fairly quick process. And it really involved us, first of all, making the decision amongst ourselves it was something we wanted to do, and then going back to our LPs and kind of laying out the bigger vision and getting them on board. So all of that, considered, it went very quickly.
What was that first around Thanksgiving conversation like? Was it a, hey, what if? Or was it a, I have a very formal plan and let's do this?
I called Chris. I was on my way to the airport in Kansas City, and I called him from my car, and I just threw it out there. I just got right to it, because I think I was cryptic. I was like, hey, I want to talk to you about something before that. And I don't know that I was really specific before the call, but during the call, I was like, hey, look, here's the deal. You're in the middle of raising your second fund. We're doing the same thing. We seem to be on exactly the same track. It was always on my agenda to have 2 partners in our second fund, and that was the first conversation. And it was like, okay, it was really just throwing it out there for initial thought, and then it just sort of went from there. And we continued to have follow-up conversations. And like Chris said, it went pretty quickly. Given the fact that it started in late November and we got it done in, I guess, officially in January, but I think really it was done a little bit before that. So yeah, the timing was, so I still look back and I was like, wow, this is like lightning in a bottle. I don't know if this is ever going to happen again, just because of how everything lined up.
Chris, when he sent you a text that said, hey, I want to talk to you about something, were you like, uh-oh? Or were you like, I'm excited?
No, I was always, one of the things I appreciate about John is he's pretty direct. So I knew when I got the message that he wanted to chat that it was probably something on his mind that was timely. So, I was not in my cards to have a second partner for my second fund. I was kind of committed to, the model seemed to be working for me as a sole GP. I had certainly had my reservations going into the first fund, but by the time the second fund rolled around, I was feeling more confident. And, having gone through the fundraising process, I was ready to kind of put that behind me. But John, as he said, he was fairly direct. And he basically said, look, I'm not necessarily looking for a partner. I'm not talking to anyone else, but if you're interested, I think we should explore this. As much as I wasn't expecting that conversation, it really didn't come as that much of a surprise because it just felt very natural from the start. And I remember getting off the phone with John. I was working from home that day and I came upstairs and I told my wife about it and she's like, wow, it sounds like this is something you want to do. And I was like, yeah, it kind of does. Huh. Just like I never really, it just, we obviously questioned it and went through the process and spent a lot of time together and all of that. But it really, from the start, felt very natural.
Something that comes up a lot of times in conversations with investors, they'll talk about how nice it is to have co-investors and kind of co-collaborators. And you guys were obviously that for a period of a couple of years. But sometimes also they'll talk about how competitive deal making is. So when you're going into this arrangement, did this feel like you were potentially losing a co-investor, or did this feel like you were losing a competitor? How did you think about that?
I'd never even thought about that. That didn't even cross my mind. And there's so many funds. There's so many seed funds out there. It's funny because that is true. Like, I guess we did lose a great co-investor, but, because we're combining or have already combined, we can put a lot more power behind the investments that we make. So, just bigger funds, larger checks. That's an interesting question. I hadn't really thought of it. I'd never thought of us as competitors. That's for sure. And honestly, I really don't, in general, I don't feel like there's a lot of heated competition between the coasts for deals. I might be naive in thinking that way, but I think there's some. I think the biggest competition that we see between the coasts is from much larger funds who decided to start doing seed deals between the coasts that are based on the coasts. So yeah, I just looked at it as how great this combination could be, and sort of the cliche of 1 + 1 = 3, or I guess 2 + 1 = 5, since there's two of us already at Firebrand. But that's kind of how I was thinking about it. I don't know. What about you, Chris?
Yeah, I definitely thought of us as much more collaborators than competitors. When you're a sole GP, you have kind of a very small group of co-investors that you trust and you lean on for their opinions, for their diligence, that you try and bring into deals. And, John was at the top of that list. So for me, I thought immediately, wow, the opportunity to have that partnership, I saw it much more as a benefit than anything else.
When you were collaborators and you both invested in those 4 deals, you both kind of got credit for those 4 deals publicly. How do you think about assigning, like, who's a lead partner? Or is it just when you find a deal, it's Firebrand invests, it's not led by Chris or led by John?
Yeah. I think when it comes to Firebrand, and it's, as John mentioned, there's 3 of us, me and John and Miranda. We really just work as a team. So we view it a little bit differently. Our dynamic internally is that every deal that we consider, we talk about, we hash through, we compare notes. It really is more of a group think than it is one person championing a deal and trying to win over the rest of the partnership. And I know that's very common in the venture world. I've lived that dynamic before. And I think that leads to some really bad dynamics within a firm and within a partnership. So we've really, I just think it's more our personalities and the way we work and the kind of foundation of our relationship that's not the way we operate. So really we just, any deal we do is a Firebrand deal. We all stay in contact with the founders. We all serve as resources for the CEO. If we're on the board, oftentimes more than one of us will try and attend any board meeting. It's just another way that we try and kind of help the companies we work with, is to have more than one person kind of familiar with what's going on and available as a resource.
John, did you sell Miranda on this idea before you talked to Chris?
So we've always had a team mentality, and so she was looped in from the start. She had met Chris before and had a really positive interaction with him, but didn't know him as well as I did, and so it was just a matter of me. She thought it was a great idea from the start, and then we had a really accelerated process, like we talked about, once we really got serious about it. And one of the steps that we took was, I forget who visited who first. I think I may have come to Boulder first, and then Chris, later you came to Kansas City, if that's right. But so Chris came to KC. He met with both of us, and we continue to have Miranda as a key member of that process, of course. So no, I didn't have to do any selling. It was a pretty easy, organic, process. And at the end of that process, we were all going to either decide, like, does this make sense, or does it make sense to stay independent from one another?
Yeah, and I actually remember that trip to Kansas City. So I flew out there. We got barbecue that night, the three of us, which is mandatory when you go to Kansas City. And then the next day, I actually spent the entire day with Miranda, just the two of us. And just with the idea of getting to know one another, understanding, for me, for my benefit, understanding where she was headed, what she was thinking, and vice versa. And it was a great day. And we ended up spending a lot of time talking about venture, but we also spent a lot of time kind of walking around Kansas City and touring the city and just hanging out. And at the end of the day, when we got together with John, I think, we were both feeling really good about it. And, I loved the idea of, like John said, we have different backgrounds, but there's a lot that's similar about the two of us, and having the benefit of a young woman's perspective on the team is really something I was excited about. So I think it's a great team dynamic, and that was something that was really attractive to me about the merger.
And if you guys don't mind, I'll take this opportunity to do a quick plug for Miranda's background for the listeners. So Miranda Manning is our principal. She's based here in Kansas City with me. Miranda and I have known each other for 5 years. We met when she joined our team at Techstars in 2015. So she had the benefit of, I think that was like what she calls like her first real job out of college, was working in the Techstars program, which is pretty cool. And so she worked for two programs, were my last two programs there. And then she was obviously the first hire at Firebrand. And she's been with Firebrand for over 2 years now.
At what point did you have to bring this to LPs, and what did that look like?
That's obviously a big piece of the equation in making this work. And as I mentioned, I had just closed the fundraising process. So I had, with an initial close, so I had just been out talking to all my LPs, selling them on the vision for Blue Note Ventures 2, convincing them that as a sole GP, this was the path that was right for us to go, and everything else. So it was an interesting conversation, but so that we got them involved very early. I think as soon as John and I were committed to this, that was the next round of conversations. And, from my perspective, it went remarkably well. People knew of Firebrand because they'd been a co-investor with us. And, once I laid out, the benefits of the combined entity, the ability to write bigger checks, the ability to expand our geographic footprint, the ability to create, partnership dynamics that would, from a decision-making standpoint, and the fact that neither of us have given up any control. Any decision we make as a partnership is like I said, groupthink. So it's not, and that was something we committed to from the very beginning. So I think it was relatively easy to get them on board, but that was a big piece of the equation and something that we gave a lot of thought to. And I was a little bit anxious about wading into it.
Yeah, I was just, on my side, it was pretty easy. It was, I think once they learned about Chris's background and what he was bringing to the table, it was a fairly smooth process. Again, I think a lot of it had to do with the timing. We didn't have to do any extra work as far as, we hadn't made any investments. We hadn't called any capital out of the second fund yet. And so I think it was a real painless process for the LPs. They all, we definitely had some good questions from them. We have, a great base of LPs that are very engaged, which I'm grateful for. So they're very supportive.
How do fund economics change when you go from solo GP and the size Firebrand was to writing larger checks, and like what changes there that might not be apparent right off the bat?
Well, part of it is just having a larger fund. So fund economics are always about, returning the fund first and getting your LPs whole first. And then obviously you kind of share in the profits, and that's fund economics. And so, we're able to a lot of benefits come with a bigger fund. As John was mentioning, we can write bigger checks. We have the ability to lead more rounds and kind of set the terms. We have a little bit more say, presumably, in the syndicates that form in those rounds. So who we're co-investing with and are maybe a little bit more attractive if the deal is competitive, because we not only write bigger checks, but we reserve more capital for future rounds. So I think there's some benefits to having a larger fund. From an economic standpoint internally, it's just everything gets a little bigger, right? The hurdle to returning the fund gets a little bit bigger, but the economics get a little bit more powerful. And of course, we now have two general partners. And so, really the economics aren't that much different for us. It's more about all the kind of benefits that come along with having a partnership and being a little bit more of a lead investor and having our kind of combined experience sets.
What happens to the Fund 1 assets? Like the portfolios you had individually, are those just legacy assets that didn't come over in this merger, or are they now kind of rolled up under this new entity?
So they are, I guess you could call them legacy in the fact that we were basically done. Blue Note was already fully deployed as far as, not making any more new investments out of the first fund. We were just completing that process when Chris joined. And so, they're just, existing portfolios that we continue to manage individually for our respective first funds. And so that's, and that'll continue until the end of those fund terms. And then, of course, the second fund is still pretty new that we're managing together.
This is something that we've never heard of before and didn't find a lot of comparable experiences happening. So, Chris, especially with your depth of history in investing, what do your peers in the venture world think of this?
Yeah, I'm not sure anyone knows what to think of this, because I think, the idea of two venture firms merging is new to the industry. I mean, I think what you see more often is a partner from one firm will move to another firm, or, one firm will maybe acquire the assets of another firm, but rarely do you see this type of merger. And I think it's, so I'm not sure people know what to make of it, but I think they get that the most important part is that the partnership between myself and John is what it's going to be going forward. And I think, using the word merger has allowed us to kind of explain it and explain how it came together so organically. And I just think, one of the reasons it doesn't happen in ventures, what we've talked about, is that the timing just really has to be perfect. Otherwise, it can get pretty complicated.
Yeah. And, I think for me, the greatest part about this merger was that it was done from a position of strength for both of us. Because I think sometimes, when any two entities merge, that's always going to be the question, is why. And, for us, it was like, look, we're both in a really strong position. Our first funds were doing really well. And, our fundraising for our second funds was going really well on both sides. So that was the best part for me. It's like, we didn't have to do this. Things would have been fine, for us individually. We just felt like it would be so much more impactful for the founders, for our LPs, if we combine forces. And so to me, that was always the best part, is that it was done from that position of strength.
How did you think about the creation of this new entity? You guys are operating under Firebrand Fund 2. Did you guys arm wrestle for who kept the brand name? Did you consider creating something entirely new? How'd you work through that?
Yes, to all of the above. No, we didn't really arm wrestle, but we did consider becoming something totally new. We considered both the existing names. At the end of the day, it was a little more practical than that. Firebrand Ventures 2, we had formed both, right? Blue Note Ventures 2 and Firebrand Ventures 2 were both operating entities. Firebrand Ventures 2 was set up to be larger. It allowed a higher level of commitment, which made it a natural selection. We liked both names, and there's something from my perspective that, Blue Note was, it was something that I was very intentional about setting up and establishing. And it was really my personal vision at that point in time for me. So there was also something that was comfortable from my perspective about leaving Blue Note Ventures as what it was and what it continues to be going forward, which was kind of my incarnation of a really intentional shift in how I approached venture and how I wanted to be seen in venture and how I wanted to do my investing. So I'm really proud of what Blue Note Ventures was, and I'm really excited to be part of Firebrand Ventures too. So that decision, it really moved pretty quickly, and I was very comfortable with it from the start.
Yeah, and I would add that we did treat it like a true merger. I mean, and I think the best type of merger, which is you incorporate the key elements from both entities. And so in this case, like, we brought over a lot of sort of the messaging, the approach, the values from what Chris had been doing at Blue Note, and sort of melded them, with what we're doing at Firebrand. We hadn't, we talked about values, somewhat at Firebrand, but I never felt like I articulated that very well. And so I think, bringing Chris on board sort of, defined all of that really well. And again, adding to what we had already been sort of working on really helped a lot.
What are we not asking about this that we probably should have asked?
It's a good question. I know we've gotten a lot of questions about this.
This is called the Jay covers his ass question.
Well, one of the things we get a lot is, now that you're in a partnership, how is the decision making going, right? We both were in a situation. I mean, John worked with Miranda, but really we both started our funds as sole GPs with kind of this, sole decision making authority, essentially. And when you're investing, that's no small thing. So I get that question a lot, like, well, how is it now that you guys have to agree on everything and you have someone else? And the answer is not that exciting, which is it's really been, I'm not sure if there's, the way, like I said, the way that we've been making our decisions in terms of more of a groupthink mentality, we tend to, even though, we have different opinions and different feelings, we've consistently gotten to the same, decisions since this thing has kicked off, which has been great. And they might be slightly different decisions than we would have made on our own and individually, but the decisions feel good and they seem very well thought out. And I think it's been all a net positive from my perspective.
Do you have a preset framework for when there is conflict?
Yeah, we've talked about this quite a bit. I think the basis of that framework that we use is, like Chris mentioned before, this is not a scenario, nor do I think it will ever be a scenario where one partner or one member of the investment team is selling the other members on an investment. I realize that happens a lot in bigger funds. I realize that happens a lot in Silicon Valley. That's not our style. There's this, well-known list called the Midas list that is a list of the individual partners at VC firms that have had a lot of success for that given year. And I kind of see it as a badge of honor to never have any of us on that list because that means we're doing deal attribution. And like we mentioned before, that's just not part of our style. So our style starts with, how do we approach this as a team? How do we let each individual come to their own conclusion by being part of the evaluation process? So for example, we might have, one of us individually might have a first meeting with a startup. And then if that's looking good, they'll bring in maybe another member. And then maybe if it continues to look great, all three of us will meet. And so first of all, we're all highly engaged with the startup pretty much from the start. So it's not a situation where someone is bringing a deal to the table and all of a sudden the other two have to catch up on what this deal even means and what this team looks like. That I think is probably the most important basis for our decision-making process, because right from the start, we're all fully informed. And then, we lead with, respect for each other, to respect each other's opinions, knowing that we're not always going to agree, but we do have a framework for, okay, what happens when one disagrees or two disagrees, how are we going to handle that? And, it's worked well. And, again, I think we all have similar enough approaches to evaluating founders. So as long as our true north continues to be investing in the team first and making sure that we don't fall in love with traction, or we don't fall in love with markets, before we fall in love with the team. If it always comes back to that, then to me, there's going to be very few times where there's a fundamental disagreement about an investment.
Yeah. And along those lines, one of the things we talk about a lot is investing in teams that, like I've mentioned, are transparent and kind of create these environments of trust and attract the best people and communicate well internally. And one of the best ways we've found to do that is really to model that in our own behavior internally. So we talk a lot about that, and like John said, we try and operate with respect and trust and very open communication. And so there's not so far, and I would never foresee it, nor do I think we tolerate it. But there's none of the gamesmanship that John's referring to. It's more just how can we make the right decision here as a group.
Well, this has been awesome, guys. Great to meet you, Chris. John, thanks for coming back. If people want to learn more about you or get involved with Firebrand after the show, where should they go?
You can find both of us on Twitter. Our website is firebrandvc.com. So those are the best places to go.
Yeah, thank you, guys. I appreciate the time, and it was nice to meet both of you.
All right, Jay, we just spoke with John and Chris from the rejuvenated Firebrand Ventures. What sparked your interest?
Ooh. Well, what was interesting to me was that everything just felt like it was easier than we expected. Everything just felt like we never heard this before. We thought it was going to be something crazy, that there were a lot of hoops to jump through. And, of course, there were some hoops to jump through, but all said, it just seemed like they realized they were in a unique period of time where they had an opportunity to do something that's never been done before, and they were just interested in doing it. So they did. And it wasn't a lot more complicated than that.
Yeah, I like that. It really came down to timing, almost. They kept on coming back to this idea of timing, and you can't time a merger, I guess, but it just happened to work out. I don't know if it's like serendipity or they're pushing too much on, hey, we got lucky, but yeah, it really did feel like it was a little, we were asking all these technical questions, right? Like, well, what'd you have to do with your LPs? And they're like, well, we just told them.
I like that a lot of this started with basically John just picking up the phone and calling him and saying, I have an idea. I like moments that stem from just, you know what? I'm going to call this person and I'm going to ask them about this, and we're going to go from there. And not like, hey, can I set up a time to talk with you a week from now for 30 minutes over Zoom? And
that's something that comes with just great rapport, though. Like when you and I started this podcast, I think we were in a similar position where you just kind of called me and said, hey, what about this thing? And I love that because it's that moment, which is really interesting, but it's the entire relationship before then that doesn't really get talked about as much.
I think it probably took a lot of humility on Chris's part to take on the Firebrand brand. It's no small thing to do a merger, which is, a merger of equals, and then basically sunset the name of a thing that you've been building and has probably been your baby for years. So I think that speaks to his commitment and his humility and his authenticity that he invests in with his founders. I imagine that was probably an interesting conversation, but at the end of the day, they have more funds now to write bigger checks, to lead more rounds, to hold more reserve capital. It seems like they've become an even stronger partner for founders here in the middle of the country.
Do you think if someone came to you who was a equal and said, hey, I want to merge podcasts with you for your podcast creative elements, but we got to scrap your name and we're going to take mine, how would that conversation go?
I don't know. I've never met anyone that was my equal.
What a pompous statement.
I'm just kidding. Just kidding.
I know.
I don't know. I feel like we'd have to have more conversations. Ultimately, I care about branding and I care about the power of branding and marketing. So I'd probably do what is best from the standpoint of what marketing and branding is meant to do. Would it be a hard pill to swallow if the brand that I came in with went away? Of course.
Yeah. I don't have the right term for it, and power couple keeps popping up into my head, but what a great, it's not right. I know it's not right. What a great pairing. I've found that whenever you have someone with a lawyer background and someone with an operator background, and you put them together, if they can work together, because a lot of times there is just it's like putting two of the same sides of a magnet together. They just jump apart from each other. But when you can find two people that work together like that, it's just like a superpower as a duo, I feel like. So I imagine that they're going to have some pretty great success here.
Totally agree. And we'll be interested to see if we see any other venture firms following this model. I feel like we've seen a lot of micro VCs start up over the last 5 years. So it doesn't seem impossible that some other groups may merge to give themselves more, financial power. But we'll see. It still seems unique, and it seems like it might be dependent on timing.
You know what? I want to pull on that thread a little bit before we close out here. There are a lot of micro VCs been popping up. There are a lot of single GP, maybe 3-person teams popping up. And when you make that commitment as a venture capitalist, you're making like a 10-year commitment from your most recent fundraise. I wonder how many people aren't fully thinking through what that 10 years looks like, and maybe have a little burnout, have a little, okay, I don't really want to do this anymore. I want to go on to my next thing. I wonder if we see an acquisition spree in the venture capital space. Maybe that's something people aren't really talking about or thinking about.
I could see it. I mean, if you go back to John's blog when he was talking about starting Firebrand and his first fund, he talks about how challenging it was. And he credits another venture capitalist who I forget her name, but she had a blog writing about the same thing. And the economics of it were like, yeah, it's a 10-year commitment. And at the size fund that you're raising, you are really setting up to not make a lot of money personally for the duration of that fund. So I think a lot of people are probably in that boat, and maybe it would make sense for some of them to join forces to give themselves a little bit more breathing room to do this thing for 10 years.
In which case, maybe there's a really interesting financial company that'll pop out of this that just goes around and buys venture capital portfolios.
Upside Financial.
What a terrible name.
Well, if one of my equals comes and tries to give me a different name, then maybe I will.
Oh, it could be an Upside SPAC. That could be us. The Upside SPAC.
I've seen SPAC all over Twitter. I don't know what it means.
You don't know what the acronym means, or you don't know what it is?
Both.
Special Purpose Acquisition Company. It is a company that takes public investment and invests in and buys out private companies, essentially.
Super interesting. We'll save that for another episode.
All right. Well, this episode has been super interesting, Jay. I learned a ton. And listeners, if you want to hit up Jay or I, you could reach me on Twitter at EKHornung or Jay at JKlause, CLOUSE, or you could reach out to us at Upside FM. If you have something a little longer, send us a note at hello@upside.fm, and we will talk to you next week.
That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter at UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Clouse are the founding parties of the Upside podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind, bro, that can't be matched. I'm lighting it on fire, used to run victory laps, and still I'm not even tired. It's all about the timing, yeah, that's what they say. Well, I'ma keep on riding.